All right, let's get right into it. We're talking about one of the hottest and, let's be honest, most confusing topics out there right now: investing in AI. It feels like a modern day gold rush, right? But with all the hype and all the noise, how do you actually find the real gold in 2025? Well, that's what we're here to figure out.
To really get why everyone's going crazy, you have to start with this number. In 2023, a key AI stock index returned a staggering 77.6%. I mean, that is not a typo. That one number basically lit the fuse, and suddenly money started pouring into absolutely anything with .ai in its name. The frenzy was on. But, after that wild party in 2023, the year 2025 has been a bit of a reality check. We've gone from that initial surge phase into what you see here: divergence and investor scrutiny. The market isn't just buying the dream anymore. Nope. Now it's demanding to see results. So the huge question on everyone's mind is the party over? Or do we just need a new map to find our way?
And that leads us to the first big fork in the road for any investor thinking about this space. Are we living through a massive dot-com style bubble that's just waiting to pop? Or is this the ground floor of a true technological revolution?
The debate here is, well, it's fierce. In one corner, you've got the bears. They're pointing to warnings from big names like Sam Altman and Ray Dalio. And they're right that many of these super hyped companies, including OpenAI itself, still aren't profitable. But the bulls, they fire right back. They say, no way, this is nothing like the dot-com era. Today's AI leaders, think NVIDIA, think Microsoft, are incredibly profitable. They have real earnings, not just speculative hopes and dreams.
So the reality is, it's not really one single unified bubble. It's much more nuanced than that. It's more like a collection of different markets. You've got these profitable giants on one side, and then you have all these more speculative application companies on the other. The real danger here is something called sentiment contagion. Basically, if the app companies fail to deliver, their failure could drag the whole market down with them. So to navigate a tricky landscape like this, we need that map I was talking about. And for our purposes, that map is called the AI value stack. Thinking about the market in these layers is absolutely key to understanding where the money is flowing and where real sustainable value is actually being built.
The stack has three main layers, kind of like a cake. At the very bottom, you have infrastructure. Then, in the middle, you've got the platform and models. And right at the core, the part we interact with is the application layer. Each of these layers has its own risks, its own rewards, and its own set of winners. Let's break them down.
First up, infrastructure. This is the classic picks and shovels play. During the gold rush, the people who made the most reliable money were the ones selling the tools to all the miners. Same idea here. We're talking about companies like NVIDIA making the chips, or ASML and Broadcom making other essential hardware. Their success doesn't depend on one specific AI app winning, it just depends on the entire AI economy getting bigger. It's probably the lowest risk part of this whole stack. Okay, moving up to the middle layer, the brains of the operation. This is where you find the tech titans: Microsoft, Google, Amazon, along with the big model providers like OpenAI. These guys are locked in an absolutely massive spending war to build the foundational operating system for all of AI. And finally, we get to the application layer. This is the real world. This is where things get really diverse and maybe a little chaotic. These are all the companies in healthcare, finance, marketing, you name it, that are using those platforms and all that infrastructure to solve very specific problems. Now, this is the highest risk, but also potentially the highest reward layer, because here you have to prove a very clear, very tangible return on investment to your customers. Okay, so now we have our map, the value stack. But every smart prospector needs a toolkit, right? Something to tell the difference between real gold and, well, fool's gold. So what are the essential tools we need to evaluate these AI companies, especially in that super risky application layer? I think it boils down to four critical questions. Number one, does the company have a data moat? Two, does it have a real plan to make money? Three, is it actually solving a real problem that people will pay for? And four, is it financially disciplined? Let's quickly go through each one. First, and honestly, this might be the most important one: data moats. In a world where the AI models themselves are kind of becoming commodities, the only truly defensible asset a company can have is its unique proprietary data. Does the product get smarter every time a new person uses it? Is their data something they generate themselves that nobody else can get their hands on? This is probably the number one question you need to ask. Next up, let's talk about making money. What's really fascinating here is the cost structure.
A traditional software company usually has these beautiful gross margins, like 80% or more. But AI companies, they have these massive compute costs, so their margins are a lot lower, closer to 50 or 60%. So the key thing to look at isn't just today's number, but the trajectory. Are those margins getting better over time? Tool number 3, product market fit. This is pretty straightforward. Is it solving a real problem that customers care about? You can usually see this in the user engagement numbers. Are people using it every day? And is the tech deeply integrated, or is it just a thin layer on top of someone else's model, what people call an API wrapper? A truly valuable company has to be indispensable. And finally, financial discipline. Look, AI is expensive. You've got high R&D costs and those insane compute costs we just talked about. A company absolutely needs a strong balance sheet and a really clear handle on its cash flow and burn rate if it's going to survive the long journey to profitability. All right, we have our map and we have our toolkit, so let's put them to work. We're going to do a quick little field test on a few interesting prospectors digging for gold in that application layer and see how they stack up.
We'll take a quick peek at 5 companies: Recursion in biotech, Upstart in financial tech, C3.ai in industrial AI, Lemonade in insurance, and UiPath in enterprise automation. It's a really interesting mix of industries and different risk profiles.
So let's take Recursion, a company using AI to discover new drugs. Using our toolkit, its biggest strength just jumps right off the page: a colossal data moat. They have something like 36 petabytes of their own biological data. That's millions of gigabytes, all generated by their own automated labs. That's an asset that is almost impossible for a competitor to replicate. The flip side, just as our toolkit would predict, a high cash burn, which is pretty typical for biotech. This slide really highlights how important execution is. Just look at the contrast between Upstart and C3.ai. Upstart went through a really tough time, but they managed a strong rebound and even returned to profitability. C3.ai, on the other hand, had what its own CEO called a completely unacceptable revenue miss, which raises all sorts of questions. It's just a stark reminder that a good idea isn't enough. You have to be able to execute.
Okay, let's zoom out from the individual companies for a second and look at the big picture. Based on everything we've seen, where's the value in this AI gold rush likely to flow over the long term?
The key dynamic you've got to watch is this shifting balance of power. Right now, the infrastructure players like NVIDIA seem to hold all the cards because their hardware is so scarce. But as that hardware becomes more widely available and the AI models themselves become more like commodities, the scales are going to tip. Power and the profits that come with it will shift to those application companies, the ones that have those irreplaceable data moats and are deeply, deeply embedded in how their customers work every single day.
And you have to remember, it's all connected by this critical feedback loop. The platform giants spend billions on infrastructure, and they're betting that the application companies will succeed and buy their services. But if those apps fail to prove their value and companies stop spending on them, well, the whole chain suffers. That's why even if they're an NVIDIA investor, you have to be watching that application layer very closely. Which leaves us with one final big question for this AI gold rush. Will the biggest fortunes ultimately be made by the companies selling the shovels, or will they be made by the clever prospectors who find a new way to use those shovels to find gold in places no one ever thought to look? That's the tension that's going to define the next chapter of this incredible revolution.